You've probably heard it 100 times. Real estate is the best way to build wealth. And every time you hear it, you think the same thing. I don't have hundreds of thousands of dollars sitting around. So you scroll past, you assume it's not for you. You tell yourself, maybe someday when you have more money, but here's what nobody tells you. You don't need a down payment on a house to invest in real estate. You don't need a landlord license. You don't need to fix a leaky faucet at 2 a.m. Real estate investing has changed, and with less than $10,000, you have more options than most people realize. This isn't about getting rich overnight. This is about understanding the real pathways that exist right now for everyday people who want their money working in real assets. Let's break it all down. The myth that's keeping you out. Most people think real estate investing looks like this. Save up $50,000, put it down on a rental property, find tenants, collect rent, repeat. That model works. But it's not the only model. And for most people starting out, it's not even the best model. The truth is, some of the wealthiest real estate investors in the world don't own a single physical property. They own exposure to real estate through funds, platforms, and vehicles that pool money together and generate returns without requiring you to own a building. Your $10,000 can get you that exposure right now, today. So let's talk about exactly how. Option 1, REITs, the simplest entry point. The first and most accessible option is a REIT. That stands for Real Estate Investment Trust. Here's a simple version. A REIT is a company that owns income-producing real estate. Think apartment buildings, shopping centers, hospitals, warehouses, office towers. The company pools money from thousands of investors, buys these properties, collects rent, and distributes the income back to investors as dividends. Congress created REITs in 1960 specifically so everyday investors could access large-scale real estate without buying property directly. And the law requires REITs to pay out at least 90% of their taxable income as dividends. That means you get paid regularly just for holding shares. You can buy REITs exactly like stocks through any brokerage account. Some REITs trade for under $20 per share. Others are available through index funds and ETFs that bundle dozens of real estate companies together. For example, the Vanguard Real Estate ETF, ticker VNQ, gives you exposure to over 150 real estate companies with a single purchase. You can start with as little as $1 if your broker offers fractional shares. Historically, REITs have delivered strong long-term returns. According to the National Association of Real Estate Investment Trusts, equity REITs have averaged around 11–12% annual total returns over the past 25 years, combining both dividend income and price appreciation. And here's something most people miss. If you hold REITs inside a Roth IRA, those dividends grow completely tax-free. You pay no taxes on the income as it compounds. No taxes when you withdraw in retirement. That combination, real estate income plus tax-free growth, is one of the most underused strategies in personal finance. So if you have $5,000 to start, you could open a Roth IRA, buy a REIT ETF, and immediately have your money working inside real estate and inside a tax-protected account at the same time. Option 2, real estate crowdfunding platforms. The second option has only existed for about a decade and has completely changed who gets to participate in real estate deals. Real estate crowdfunding platforms pool money from multiple investors to fund specific real estate projects. These might be apartment developments, commercial buildings, fix and flip projects, or rental portfolios. Instead of needing $500,000 to invest in a development deal, you might invest $500 or $1,000 alongside hundreds of other investors. Platforms like Fundrise, Realty Mogul, and Arrived Homes have brought this model to everyday investors. Fundrise, for example, allows you to start with as little as $10. Your money goes into a diversified portfolio of private real estate projects across the country. You earn quarterly dividends from rental income and potential appreciation when properties are sold. Arrived Homes works slightly differently. It lets you buy shares in individual single-family rental homes. You pick the property. You see the address, the expected rental income, the projected returns. You invest as little as $100 per property. The platform handles everything, finding tenants, managing the property, collecting rent. You receive your portion of the income. These platforms are not as liquid as REITs. You can't sell your investment tomorrow the way you can sell a stock, but they give you exposure to private real estate deals that were previously only available to wealthy, accredited investors. If you have $2,000 to $5,000, spreading it across a few crowdfunding platforms gives you genuine diversification inside real estate, different property types, different markets, different risk profiles. Option 3, house hacking. Now here's where things get interesting. If you're willing to think a little differently about where you live, house hacking might be the most powerful real estate strategy available to someone with under $10,000. House hacking means buying a property, usually a duplex, triplex, or fourplex, living in one unit and renting out the others. Your tenant's rent covers most or all of your mortgage. You essentially live for free or near free while building equity in a property. With an FHA loan, the federal government's low down payment mortgage program, you can purchase a home with as little as 3.5% down on a $200,000 duplex. That's $7,000. That's within the range of a $10,000 budget, especially when you factor in closing cost assistance programs available in many states. The numbers can be striking. If you buy a duplex and rent the other unit for $1,200 a month, and your total mortgage payment is $1,400, you're living in your own home for $200 a month. Meanwhile, the entire property is building equity every month. You're paying down a mortgage, but mostly with someone else's money. Real estate investor and author Scott Trench popularized this strategy in his book, Set for Life, and it has become a cornerstone of the FIRE movement, financial independence, retire early. The reason is simple. Housing is most people's biggest expense. Eliminate it, and your savings rate skyrockets. House hacking requires more effort than buying a REIT. You have to manage tenants, maintain the property, handle the logistics of being a landlord. But for someone serious about building real wealth through real estate, it remains one of the highest leverage moves available with limited starting capital. Option 4, real estate notes and hard money lending. This one is less commonly discussed, but it's worth understanding. When someone takes out a mortgage to buy a property, that loan, called a note, can sometimes be bought and sold. Real estate note investing means you become the lender. You're not buying the property. You're buying the debt secured by the property. If the borrower pays, you collect interest. If they default, you have a legal claim on the property itself as collateral. Done carefully. Note, investing can generate steady income, often 8% to 12% annually, without any of the headaches of being a landlord. Some platforms, like Peer Street, have made this accessible to smaller investors. This is more complex territory and carries risk you need to understand the terms of the note, the property's value, and the borrower's financial situation. But it illustrates an important point. Real estate is not just about owning buildings. It's about capital flowing through the real estate ecosystem. And there are multiple places in that ecosystem where your money can generate returns. How to think about allocating your $10,000. So if you're sitting here with $10,000 and you want exposure to real estate, what does a smart allocation actually look like? Here's one framework to consider. Start with your emergency fund. Before you invest a single dollar in anything, make sure you have 3 to 6 months of living expenses in a high yield savings account. If your $10,000 is your entire financial safety net, investing all of it in real estate is not wise. Liquidity matters. Protect that first. Once your emergency fund is secure, suppose you have $5,000 ready to invest in real estate. A simple starting allocation might look like this. Put $2,500 into a REIT ETF inside your Roth IRA. This gives you liquid, diversified real estate exposure with tax-free growth you can add to it every month, even in small amounts. Put $1,500 into a crowdfunding platform like Fundrise for private real estate exposure different from publicly traded REITs, which adds diversification. Put $1,000 into Arrived Homes or a similar platform to own fractional shares in 1 or 2 individual rental properties. This teaches you how rental income actually works at a granular level. That's $5,000 working across 3 different types of real estate investing. Each one behaves differently. Each one teaches you something. And each one is growing while you continue saving. As your knowledge grows, as your income grows, as you build confidence, you can scale. Maybe in a few years, house hacking becomes the right move. Maybe you go deeper into REITs. Maybe you explore commercial real estate funds. The pathways keep opening. The bigger lesson about real assets. Here's what real estate actually gives you that stocks alone don't. Tangibility, a claim on something physical. When you own real estate directly or through a fund, your investment is backed by land and structures that have intrinsic value. People always need places to live, work, and store goods. It also gives you inflation protection. When inflation rises, real estate values and rents tend to rise with it. Your REIT dividends adjust. Your rental income increases. Real assets are one of the oldest inflation hedges in financial history. And it gives you diversification. A portfolio built only on stocks is exposed to market sentiment, corporate earnings, and investor psychology. Adding real estate exposure, especially through private market platforms, lowers your correlation to stock market swings. The wealthy don't put everything in one asset class. They spread across stocks, bonds, real estate, and other assets. Real estate is how most wealthy families have built and preserved wealth across generations. Not because it's magic, because land is finite, demand is persistent, and income from property is one of the most durable cash flows in existence. Your first step is simpler than you think. You don't need to figure all of this out today. You need one first step. Open a Roth IRA if you don't have one. Buy a REIT ETF inside it. Start with whatever you have, even $500. Set up an automatic monthly contribution, even $50. That one action puts you inside real estate, inside a tax-free account, with compounding beginning on day one. The person who told you that real estate was only for people with a lot of money, they were describing a world that no longer exists. The tools available to you right now, REITs, crowdfunding, fractional ownership, FHA house hacking, have democratized one of the oldest wealth building strategies in human history. You thought real estate was out of reach, but the only thing that was actually out of reach was the information. Now you have it.